It is Monday morning. Thank you for joining me. I'm Jason Sen. This is the gold chart. Spot gold, not the futures. Gold's been in a decline since the beginning of May, and we have tested the 100-day moving average, the blue line. Now, normally I would buy into a long position at the 100-day moving average in a bull trend, and we are in a bull trend. Well, we are in a short-term bull trend. You can see we had a big decline from March to November. We had the triple bottom. Do you remember the triple bottom? And then up we went. So we've got this V-shaped recovery. So in the longer term, we're not in a very clear trend at all. In fact, if I go to the weekly chart, just so you can see the longer term perspective. There you go. Don't forget, triple top. I've been talking about this triple top in gold for months. We have been trading in a massive sideways range for gold ever since we hit the all-time high at 2072. So that's the very long-term perspective. We're in a sideways trend. Slightly shorter term perspective is that we are in a bull trend. From November to May, we had a real good run up. So I'm going to take that as the prevailing trend at this stage. So I would normally be thinking we've had a correction in a bull trend, buying into a long position at the 100-day moving average. That would be a great strategy. And I'm not saying it won't work because gold is oversold after such a sustained move lower throughout most of May. But I would want to see something else. I'd want to see a trend line, something else indicating to me there was more than just one area of support. We broke the 23.6% Fibonacci level. There's no trend line. If you want to take a risk and buy at the 100-day moving average, well, you can have quite a tight stop, and it could be worth it because the first target could be around 1965, 1970. So you could have a 25, maybe 30 point profit potential on that. And if you're only going to risk 10 points on it, the risk reward does make sense. So if you think that gold is going to bounce, that might be a strategy that's worth looking at. We do also have the 500 period moving average on the 4-hour chart, lending extra support around these lows. Something to bear in mind if you're thinking about trying a long position and looking for a bounce in gold. On the 1-hour chart, you could argue this is a double bottom because on Friday, we did almost retest the low on Thursday. I certainly would not still be short. We've been shorting gold, selling on rallies, and that strategy has worked. I wouldn't be short gold right now unless we break below that 100-day moving average. So unless we break below 1925. So for now, a bounce is possible. I'm just making you aware of the risks. It's not the strongest support level out there. It's only being held by moving averages. We could bounce to the mid 1950 area. I had resistance there actually on Friday. We made a high for the day exactly at 1957. I had resistance 1952. 1957. If you did sell into a short position there, then you did pretty well. There was a good 15-point profit, almost 20-point profit, depending on where you entered the short position. So today again, resistance around the mid 1950 area. We've got the 100-hour moving average there at around 1956, 1958. But the big resistance for me, and we could get all the way up to 1965, 1970. Now that looks like the strongest resistance level of the week. Got the 200-hour moving average there. We've got a trend line stretching quite a way back, as you can see there. And we've also got the 23.6% fib at 1970. We could definitely see a high for the day if it is reached today or tomorrow. Don't forget it's Memorial Day today, so trading volumes will be very thin. We've also got the US non-farm payroll release on Friday. It's one of the biggest economic releases out of the US for the month. It will be very closely watched, and therefore trading might be quite subdued up until Friday, bearing in mind the bank holiday on Monday. Okay, I hope that's helpful. I'll have another video for you tomorrow morning.